Welcome to the PJ Finance Show.
Today we will talk about lessons from Japan. Phoebe, come take a look at this. They had 20 years of zip in Japan. There is a zero interest rate policy in place, as well as a negative interest rate policy, which has been quite unusual.
Wow, negative interest rate. This means if I buy a bond or put my savings in the bank, I have to pay interest?
Yes. On the flip side, the borrowers do not pay interest rate and instead, they receive interest payment. In Monetary Policy 101, the textbook taught us that reduced interest rates should lead to an increase in bank loans. This graphic from Japan, on the other hand, suggests differently. As the blue line showing interest rate declining, the white histogram is showing that borrowing from financial institutions were declining as well. Very strange that lower interest rates did not lead to more loans and instead, they had less borrowings. It gets weirder that when the interest rate fell to zero, there were negative borrowings. What are negative borrowings?
Negative borrowings means that loans were being repaid.
Consider a business with a balance sheet that started with 20 million yen in equity and borrowed 80 million yen to invest 100 million yen in the asset. This asset has increased in value to 110 million yen, which is great news for them. The equity is now worth 30 million yen. So, from 20 to 30, they're getting a 50% ROE return on earnings. As this chart showing data from Fred, if I had bought shares or real estate in Japan during the early years, it would have gone up by about 10%. The index moving from 100 to 110. And then both the stock market and land values plummeted.
Is this to say that whatever was worth 110 million yen is now worth 20 million yen, and these corporations still owe 80 million yen?
Correct. What is their equity now? Negative. They are effectively bankrupt. If a business were to go bankrupt, would they want to borrow money? Or would any bank be willing to lend it more money? Of course, the answer is no, no matter how low interest rates has gone down to. As a result, the environment has altered in Japan after the financial markets have crashed, with corporations shifting their focus from profit maximization to debt minimization. So, in the case of Japan, there are companies like Sony and Toyota that still generated a lot of cash flow monthly. And what do they do with all this money?
They use this to pay off debt because most if not all assets they owned has depreciated significantly, leaving them with no choice but to pay off the debt.
True. They will continue to pay down debt even if the interest rate falls from 3% to 1%. So if the interest rate dropped from 1% to 0%, they would still pay down the debt because they want to pay it off as soon as possible.
Even when interest rates are negative, they continue to pay down debt. High-powered money, as you may know, is money created by the central bank. So, it explains why monetary policy, on the other hand, would be ineffective in a balance sheet recession, where corporations have too much debt. As a result, any increase in high-power money did not result in a significant increase in the money supply.
Yes, we must recognize that the world can deviate significantly from textbook economics, and the fact that when there is a balance sheet recession, monetary policy is no longer effective. For monetary policy to grow the economy, the central bank must boost the money supply. Secondly, borrowers must exist, and lastly, banks must be willing to lend.
Thank you for the extremely helpful explanation, Joe.
You're most welcome. Let's have a coffee after talking for so long. And Phoebe, you are buying. I want an extra large frappuccino, with a supersized cookie.
I was thinking about sushi and iced matcha green tea latte.
Monetary policy has its limitations. Easier monetary policy can be ineffective after an asset bubble burst when lower interest rates do not transmit to more borrowings.
Thank you for watching.
This presentation on lessons from Japan is brought to you by the PJ Finance Show.